Welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst in IronFX. In front of your screens, you have Euro USD's daily chart. Now, at this point, I would be noting that we have, and we will be mixing technicals with fundamentals. Definitely, yesterday it was the Fed's day. However, I would be noting that, we had considerable market reaction from the release of the Fed's interest rate decision, the late American session yesterday. However, I think that market volatility started with the release of the US CPI rates for May. That was at the beginning of the American session. The CPI rates ticked down and slowed down on a year-on-year level, both at the core as well as the headline rate. That was a clear sign that inflationary pressures may be starting to ease once again. I would also note that on a month-to-month level, we saw the headline rate actually slowing down to 0%. That would be stagnation levels, practically implying that inflation did not accelerate in the past month, which was maybe the most impressive element of the release. And the release as such tended to weigh on the USD, and it would be interesting to see the market reaction on Euro USD's 1 minute chart. Let's unlock this and have a look at the time of the release, how the market reacted. And you can see the market surprise as the US dollar was on the sale from the time of the release up until the next 3 minutes. 1, 2, 3, 4 green candlesticks in a row. We saw a market reaction which pushed Euro USD higher at around 60 pips. That was substantial rise. And it even continued to rise even higher in the following hours, up until the Fed's interest rate decision. In the late American session yesterday, you can see how the price action of Euro USD moved lower, 27 pips. And that would be implied practically by not the interest rate decision as such, but by the altering of the expectations. The release of the interest rate decision, along with the accompanying statement and the bank's projections, tended to weigh on the US dollar. At the time of the release, it was very, very obvious. You can see it right here. But later on, also during Fed Chairman Powell's press conference, which started around here, you can see how the price action of Euro USD continued to move even lower up until here and remain at that level for a longer period, practically implying that the bullish tendencies for the USD side of the pair were maintained later on. So practically Fed Chairman Powell's press conference, despite some, I would say, effort on behalf of the Fed Chairman to actually moderate any market reactions, he was not able to avoid any strengthening of the USD. At least at the time of the press conference as such. Later on, we saw that Euro USD regained some strength, moved lower once again. So overall, we note that Euro USD was allowed to strengthen mostly due to the market reaction of the US dollar, of the weakening of the US dollar during the release of the US CPI rates for May. That was the main element of the day yesterday. Regarding the Fed's interest rate decision, this is the daily chart. I would be noting, or if you prefer, I would analyze the release on an element-by-element basis. We had the interest rate decision as such, at which the bank remained on hold. That was widely expected. That was nothing out of the ordinary. I would be noting here also the forward guidance in the accompanying statement may also have not been anything out of the ordinary. Practically, the bank reiterated the idea that it remains data-based, or if you prefer, data-dependent, So practically, it's in a wait-and-see position how tendencies within the US employment market and the US inflationary front are going to be evolving over the coming months. And depending on the data coming in, it will decide its further moves. I would say that the surprising element was on the bank's projections and especially the new dot plot. The new dot plot tended to highlight that Fed policymakers are prepared to actually maintain rates high for longer. Later on, we had Fed Chairman Powell's press conference. At the press conference, the Fed chairman actually once again stressed that the bank is data dependent, trying to erase the bullish effect which for the US dollar, which was more evident, if you prefer, from the new dot plot. And I think that partially he failed to actually materialize on that. On the other hand, we have also to note that markets' expectations have shifted even stronger towards expectations for a rate cut in the September meeting and a second rate cut in December. So practically, despite some slight strengthening of the USD at the time of the release and Fed Chairman Powell's press conference later on, overall market expectations are still for the bank to remain on hold in August and start cutting rates in September and December. So overall, we see that monetary policy-wise, the USD, despite some question marks, may weaken from the Fed stance. Now, you can see how Euro USD rose yesterday, corrected a bit lower, yet broke the 1.0790 and remains rather stable during today's Asian and early European session. So practically this has to be changed into a support line. Let's color this in green. Let's correct also the labels, starting with the R3 at 1.0980, the R2 at 1.0915, the R1 at 1.0840, the S1 at 1.0790, the S2 at 1.0730, and the S3 at 1.0670. Sorry. So on technical basis, we see the case for the pair to remain in a sideways motion. And allow me to draw this. And I think it would be more obvious if we saw this movement here. The price actions upward movement, which had started since around the midst of April, has been interrupted. That's clear. That has been ongoing since Friday. And the price action remains in a sideways motion, this time between the S2 and the R2. However, we have some mid levels in play. Overall, though, we tend to maintain a bias for the sideways motion to continue. And I wouldn't be surprised to see that being maintained over the next 48 hours. We have very little which could actually move the pair directly, either on the US dollar as well as on the euro side. On the one hand, we have some comments by Fed policymakers later today and tomorrow. We have more European policymakers which more or less tend to provide or could provide some support for the euro side of the pair should they sound hawkish enough. I would expect that most probably we may be seeing here some support for the euro side of the pair, which could pull it upwards. However, for the time being, we do not see any major game changers in play. Now, as for the questions about which indicators we are using indicators as long as they have something to say. And allow me once again to delete the rectangle we have just drawn, so we can clear the chart. Now we tend to maintain a more simplified version of the chart, and we tend to use practically 1, 2, 3 indicators. The first would be the Bollinger Bands. The Bollinger Bands, you can see them right here. We have a mid level, which is the 20 moving average, the upper boundary, and the lower boundary. Now, the Bollinger Bands are practically the 10-day moving averages, which are surrounded by 2 standard deviations. It's a statistical method, and that tends to allow us to have a certainty of around 95% about the price action remaining within the boundary set. The second indicator I would be highlighting here would be the RSI indicator below, which is currently implying that the price action remains in a sideways motion, given that the indicator's reading is at the reading of 50 and tends to imply more or less a rather indecisive market. Any movement of the RSI indicator towards the reading of 70 right here would be implying us more or less a bullish sentiment predisposition on behalf of the market, while any movement lower towards the reading of 30 would imply a selling predisposition of the market. Should the readings drop below the reading of 30, then we may be talking that the pair is at oversold levels, while should the price action of RSI breach above the reading of 70 would imply that the price action is at overbought levels and maybe ripe for correction lower. Last but not least, I would be noting also the moving averages. Here we have in the orange line the 100 moving average, and the green line the 50 moving average. You can see how they have flattened out and are coinciding right now, also tend to imply a relative stabilization for the pair. Let's have a look at USD/JPY. USD/JPY remains in a sideways motion despite a correction lower yesterday. And allow me to readjust the chart a little bit. There you go. So we tend to maintain the bias for the sideways motion between the R1 and the S1 to be maintained for the time being. On that flip side, though, I would be highlighting also the upward channel, which has been guiding the pair's movement since about the end of the year, last year. So more or less, we maintain a bias for the sideways motion to continue, yet we are also issuing a warning about any bullish tendencies in play here. The RSI indicator has jumped slightly above the reading of 50, which tends to imply that we may see the starting of a slight buildup of some bullish tendencies, yet that remains unconvincing for now. I would expect the market to remain rather uncertain about the future direction of the pair's next leg. One interesting element which we could mention here is that we have the full body of the Bollinger Bands, the channel, moving upwards. That includes also the 20 moving average with an upward slope. Similarly, we have an upward slope by the 100 moving average, which is the green line, and the 200 moving average as well. All of that tends to imply that there will be bullish tendencies. However, for a bullish outlook for the pair, I would require a clear break of the 157.75 resistance line, the R1, and the price action to start aiming for the 160.20 resistance level. Now, at this point, we have to note here two elements. They are both fundamentals. The first element is that the Japanese government, in coordination with Bank of Japan, already intervened in the markets once, and you can see it right here. And that was on the 29th of April. However, the market intervention was once market let loose on the 30th, and on the 1st of May, 2nd and 3rd of May, once again intervened. So practically, should the pair actually breach the R1 and start aiming for the R2, the pair risks a possible market intervention by the Japanese government in coordination with BOJ. That's the first fundamental issue. The second fundamental issue would be BOJ's interest rate decision tomorrow during the Asian session. It's going to be, I think, the main market mover, and if not market mover, definitely the main point of interest for JPY traders for the week. Now, BOJ is expected to remain on hold at plus 0.1%. That's not the question. JPY OIS imply probability, a very high probability for the bank to remain on hold. So that's more or less out of the picture. The main element which we will be focusing on, should the bank remain on hold as expected, would be the bank's forward guidance, which is to be included in the accompanying statement. Probably the bank may keep the forward guidance relatively unchanged, slightly towards the hawkish side. Should there be a tweak, I would expect the tweak to be more tilted towards the hawkish side, and I'm highlighting this because we had an acceleration of the earnings growth rate in Japan, which more or less was one of the key indicators, or if you prefer, prerequisites of the bank to keep a tight monetary policy or even tighten it further. So we may see the bank sounding somewhat hawkish, and should it tweak its forward guidance, we may see it sounding even more hawkish. The big question, though, is the following. Will the bank actually be able to convince the markets or not? That's my big question. Because in the last interest rate decision, the bank did sound hawkish. However, the markets remained rather unconvinced about the bank's intentions. And should we see the bank failing to convince the markets, then we may see JPY weakening once again. We saw that happening in the last interest rate decision. I wouldn't be surprised to see that happening tomorrow as well. Okay, let's have a look at cable. As expected, cable remained in a sideways motion between the R1, 1.2805, and the S1, 1.2680. Now, despite the false break during yesterday's American session, if I'm correct, let me confirm that. Yeah, despite a false break, you can see it right here in the early American session yesterday, we tend to maintain a bias for a sideways motion between the prementioned levels to be maintained. On the flip side, we have to note here that the RSI indicator remains above the reading of 50. It's not so clearly near the reading of 70, but there seems to be a bullish predisposition on behalf of the market. And at this point, I would be noting out that we have also an upward trend line, which tends to imply or highlight a possible upward movement of the pair since around the last days, mid to last days of April. Once again, though, I would require for a bullish outlook the price action to breach the R1 1.2805. Clearly, that would mean that it has to move above the R1 and actually use the R1 as a support line. However, in my opinion, given that I'm rather conservative here, I would require the pair to also breach the R2 1.2890. Should the R2 be broken, yes, then we would be switching clearly towards a bullish outlook. On the flip side, should the bears take over? For bearish outlook, I would require cable to breach the pre-mentioned upward trend line in a first signal that the upward movement has been interrupted. However, for bearish outlook, I would also require the pair to breach below the S1, 1.2680, and start aiming for the S2, you can see it right here, 1.2560. So practically the price action has to drop, break the upward trend line, break the S1, and start aiming for the S2. That would also allow us to start drawing a downward trend line, or at least show us the limitations of the downward movement. Let's have a look at USD CAD. Sorry. Now, USD CAD yesterday moved lower, tested the 1.3690 support line, yet was unable to clearly breach it. Nevertheless, one could argue for some bullish tendencies. And I'm mentioning this because you have one low and the second low, you have a peak, but you have no second higher peak. So for a bullish outlook, we would require the pair to have a higher peak than this one. So the price action has to breach above the 1.3785 and remain above it. That would give us a second higher peak, which in turn would allow us to start drawing an upward trend line. For the time being, and until that level is broken, I would expect the pair to remain in a sideways motion between the R1 and the S1. Should the S1 be broken and we see the pair aiming, if not breaching the S2, actually I would require lower true than this one, these two here. So the S2 has to be breached. Then I would be considering, if not even adopting, a bearish outlook. I see in the comments here that we have a comment about the Fed's interest rate decision actually siding towards a hawkish side on inflation, which could provide support for the US dollar. The market does not seem to be convinced on that. And I'm highlighting this because the market seems to still be increasingly expecting that the bank will start cutting rates in September. On the other hand, we see also a comment about a possible safe haven inflows regarding geopolitical tensions or economic concerns in other countries, which could increase demand for the US dollar. Yes, that's a probability which I would agree with. However, once again, we have to see such an escalation of geopolitical tensions being on the rise, which could shake the market somewhat and thus provide, I would say, some uncertainty and some safe haven inflows for the USD. Okay, let's have a look now at AUD-USD. AUD-USD moved upwards, and the beautiful part of yesterday's movement was the fact that it has verified practically the sideways motion between the S1 and the R1. It's beautifully how the pair's price action tested the S1, actually bounced on it, and aimed for and almost reached the R1. So that sets the prerequisite of a sideways motion between the pre-mentioned levels, and we tend to maintain a bias for the sideways motion to continue. May I also add here that we have a flattening out of the moving averages, especially the 20 moving average, but also in the orange line, the 200, and the green line, the 100. Also note how the RSI indicator continues to rotate around the reading of 50, implying a rather indecisive market. All of that tends to imply the continuance of the sideways motion. Should the bulls take over, I would expect nothing less than the price action to breach the R1 0.6710, and I'm mentioning this because I would require practically the pair to breach or mark a higher peak than this one, or this one. So practically the price action has to rise above the R1 and start aiming for the R2 0.6780. On the flip side, for a bearish outlook, I would require the pair to drop below the S1 0.66 and start aiming for the S2 0.6515. Nothing less. At the same time, on a fundamental level, my worries about the Aussie have to do with its commodity nature on a fundamental level. The Aussie is considered the commodity nature given that Australia is an raw material exporting economy. And we're talking about copper, we're talking about coal, iron ore. So the Aussie is considered as a riskier asset. Hence, whenever we see the markets psychology being more positive and more risk oriented, then we see the Aussie getting some support. On the flip side, should the market stance become more cautious, then we may see the Aussie being sold. So that's an area I would be placing considerable emphasis upon. The second issue I would be highlighting about the Aussie would be that I would expect also to have some tensions in the US-China relationships, and or if you prefer, some escalation of the tensions in the US-China relationships, especially about Taiwan. It's not the case just yet. However, it's a probability which we should keep in mind. And should we see escalations in the US-China relationships, we may see the Aussie weakening. And the main reason why is because practically Australia has a wide number of exports towards China, and an escalation, the tensions could actually weigh on the export side of the Australian economy. Okay, let's have a look at WTI. We can see how WTI's price action edged up yesterday, yet is correcting lower today. On a technical level, the main element to which we tend to focus upon is the possibility of the price action of WTI actually breaching the upward trend line, which has been guiding it since the past week. Yep. Should that be the case, then we have two elements in play here. The first element would be whether the price action will be also breaching this one, the 76.65 support line. And if the support line is breached and the price action forms a lower trough than this one in the next week or so, then we may be talking about a bearish outlook. Why? Because then it would be a verification of this downward motion. If, on the other hand, the price action follows the upward trend line, which has been forming for the past week, and rises above the downward trend line we have just shown, possibly aiming, if not even breaching, the 80.10 resistance line, then we're talking about a clear-cut bullish outlook. I wouldn't be surprised to see the correction lower, given that we have a rather steep ascent, and at the same time I would be noting the possibility of a sideways motion. Why? Because the RSI indicator remains near the reading of 50. It's running along it actually, implying a rather indecisive market. That's why we had only small immaterial rise of oil prices yesterday and the day before, while we even have a correction today lower. At the same time, I would be noting the flattening out of the moving averages. We're talking about the 50 moving average, which is the green line, the orange line, which is the 100 moving average, and the blue line, which is the 20 moving average. All three of them are flattening out, implying more or less a relative stabilization of the commodities price. Should the price stabilize, I wouldn't be surprised to see it remaining within the boundaries set between the R1 and the S1. Let's have a look at gold. Sorry. Now, first of all, I would be deleting the possibility of any head and shoulders scenario. That does not seem to be playing out unless we are talking about an extended head and shoulders. Yet I would expect, actually, if it was a head and shoulders, the drop to have happened over the past 2 days. It didn't. So we may be talking about the downward motion, given that the price action of gold briefly breached the R12320 yesterday and corrected lower during today's Asian session and your early European session. So we may be talking about some slight bearish predispositions, but the RSI indicator remains close to the reading of 50, which tends to imply that no bearish tendencies have been built up within the market sentiment. So for the time being, we tend to maintain a bias for the sideways motion to continue. We may see the price action of gold revolving around the 2320 level, and I wouldn't be surprised to see it breaking up and down a little bit here and there over the next 24 hours, maybe even 48 hours. Should a bearish outlook appear, for bearish outlook, I would require practically a lower trend than this one. So the price action has to drop over the next 3 trading days, breach the S1 2277 and start aiming for the 2227. On the flip side, should the bulls take over, I would require the precious metals price to rise, definitely breach above the 2320. Also breach though the R2 2363, breaching thus also the downward trend line, and start aiming for the 2400 resistance level. Let's have a look at your stock markets. Now this is Dow Jones. Dow Jones remains in a very clear-cut sideways motion. And it has been doing that over the past week plus, just below the 39,140 resistance line. But also you can see how it previously respected the 38,000 support line. So we expect the sideways motion to be maintained, given that it has tested but not breached materially the R1. Nothing less. Should the bulls take over? Yes, at that point we may see the price action of the index breaching the R1 and start aiming for the R2. The R2 is an all-time high level practically, as it was tested twice. So that's a level which we should keep an eye out. The double top formation, which was predicted by some, did not pan out. For a bearish outlook, though, I would require the price action of Dow Jones to breach the S1 38,000, as I would require a lower trend than this one, and the price action to start aiming for the S2 37,100. Let's have a look at a different picture, and that would be Nasdaq. There you go. Now, Nasdaq yesterday practically breached to new all-time highs. it has breached the 19,300. It's currently at 19,580 almost. So definitely the R1 has to be turned into support line. It's a very different, a totally different picture than what Dow Jones is implying here. And in my opinion, that tends to highlight more or less the bullish outlook of the tech sector. And allow me to place the new R3. Let's correct the labels as well. We're placing the new resistance lines given that we are at uncharted waters based on the volatility which has been present for the index over the past 1 month. And we place the R2 at 20,800. The R1 at 19,900. So we tend to maintain a bullish outlook for the index. Moving now to the support lines at 19,300, 18,500. So we maintain a bullish outlook, yet I would like to issue a warning here. And the warning is as follows. You can note how the price action has breached above the upper Bollinger Band, which in my opinion may slow down the bulls substantially, if not even force the index's price action to correct lower in order to be included once again within the bands. At the same time, I expect that the bands will start widening once again. Similar signals we are getting also from the RSI indicator, which has breached above the reading of 70, which tends to imply that the index is at overbought levels and may be ripe for a correction lower. So once again, we maintain a bullish outlook for the index, yet issue a warning about a possible correction lower. And I'm stressing this. Should such a movement be lower, most probably it will be a mere correction and not a change of trend. For a change of trend, and I'm talking about turning the bullish outlook into a bearish one, I think the bar is pretty high and such a scenario is very remote, but for such a scenario, we would require the price action of the index to drop, breach the S1, 19,300, breach the upward trend line, and also breach the S2, 18,500, having a lower point than this one. So that would mean that the index has to start aiming, if not breaching, the S3, 17,800. It's very, very interesting, the contrast between the tech sector as described by NASDAQ and the elite, which is described by Dow Jones. I think we should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Okay, let's go ahead and get started. So, welcome to this week's webinar. Today, we're going to be talking about the last part of our Fibonacci series, which will be on projections. So, as per usual, before we get started, a risk warning. So, our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, I'm Melanie. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. And I will be your speaker for today. So here's today's agenda. We'll do a brief recap on a Fibonacci retracement, the ideal market structure, and then we're going to look at the different Fibonacci retracement levels, and then we'll dive into this week's topic, which is on Fibonacci projections, and then we'll look at how we combine what we learned from the previous weeks and what we're going to be learning today on Fibonacci projections. Okay. And if we have time at the end, we'll also be looking at some charts. So if you have any requests, feel free to pop them into the chat. Also, if you have any questions throughout the webinar, feel free to let me know as well. Okay, let's get started. So here's a simple checklist to follow when first starting out with Fibonacci retracements and some things that you can look out for. So firstly is the market structure curve. So you want to be looking for big zigzags, and we'll show you examples in the coming slides. Next, we're looking at how we can identify the recent trend. So are prices going down or up? And our typical advice is to always follow the general trend. Next, identify a recent major swing low and recent major swing high. So we'll show you examples, but basically you want to look for the most significant swings when you are deciding which charts to use. Next, you want to connect the two extreme points, the highest to lowest, if you are looking at a downtrend, and the lowest to highest if you're looking at an uptrend, like you see here in this image. Okay, so let's first look at an incorrect example. So here's an example of an insignificant swing, which are typically bad points to use for Fibonacci starting and ending points. Price movements here are too small and there are no significant swing highs or swing lows. So you can see we're drawing out the shape, and this is the kind of shape that you want to avoid. Here's another incorrect example. You can see there isn't really any clear shape, even though you can see that the general trend is downwards, but there's no clear swing highs or lows. Price movement is also pretty small. Okay. Okay, now let's look at some correct examples or things that you should be looking out for. So here's an example of significant swings. You can see that there is a clear move up and down with obvious peaks and troughs, and also there are clear market movements. Okay, here's another example. So I've drawn out the peaks and troughs to point out exactly how clear your market structure should look like. Okay. Okay, next point, we want to make sure that you are following the market structure. Okay, here is an example of how not to draw your Fibonacci retracement trend line. So your Fibonacci trend line must follow price structure clearly. In this case, you can see that there is a zigzag market structure. The retracement drawn here cuts through the market structure, making it less effective. So when drawing your trend line, you want to follow price movement and not deviate from it too much. Okay, so something like this, you want to pick market structures with clear upward or downward movement and something that follows price movement. This works better on higher time frames, as there tends to be less noise. So higher time frames could be one 1 hour to 1 hour, 4 hours, 1 day, 1 week as well. Okay, so here's an example again of a clear market structure. So Fib tracements can be used in both choppy and trending markets, but it is important to look for clear market structures. Okay, so if you look here, there's a lot of upward and downward movements. So that's what we mean by choppy and trending markets. But the main point is to make sure that your market structure is clear. So here's an example of an unclear market structure. So once again, it is choppy with a significant drop here, significant highs here, but you can see there isn't really a clear market structure. Okay. Okay. Now, these are the Fibonacci numbers that we typically use. So if you've been here for our previous Fibonacci webinars, this will look familiar. But basically, this shows you how you draw your Fibonacci retracement trend line and also the different types of levels, ranging from the negatives to levels that are greater than 100. So the tool that's used is a Fibonacci retracement tool, but it can lead you to 3 types of Fibonacci techniques. So previously we talked about the expansions, which are the negatives, the mid-range, so 23.6 to 78.6. Those are called the retracements, and those greater than 100% are the extensions. So we went through these in our previous webinars, but if you'd like me to briefly go through them again, feel free to let me know in the chat. Okay, so here you can see all the different Fib numbers that we mentioned in the previous slide and how it looks like on a chart. So just to recap again, mid-range is retracements, negatives are the expansions, and 100% are or greater than 100% are the extensions. And in all of these scenarios, we are only using one tool, which is the Fibonacci retracement. Yeah, I think it is recording. I think they might publish this webinar on YouTube as well. So you can go ahead and check it out. But if it's not on YouTube by I think the end of next week, you can email IronFX and they'll help you out there. Okay, so let's move on to this week's topic, which is the Fibonacci projection tool. Yep, you can find me on LinkedIn. I'll pop it into the chat in a little bit. Oh yes, I also wanted to share with you guys this website. So if you're new, when it comes to Fibonacci's, okay, you can go on to theforexarmy.com and it shares exactly how to draw Fibonacci retracements, and watch a bunch of videos, extensions, and it shows you an in-depth instructions on what to look out for. So you can see that we recently talked about the unclear market structure, and now this shows you an unclear market structure from an M15 view can actually look clear on an H1 view as well. Yeah. So this area here that we've highlighted is the market structure that was on the M15 view. And yeah, so just because it looks unclear on one time frame doesn't mean that it's not usable. So yeah, you can feel free to pop this to check this out after our webinar. Okay. Yeah, so let's get back to our slides. Yes, so we're talking about Fibonacci projections. So for Fibonacci projection, this uses 3 points. We have a starting point, a middle point, and ending point. So yeah, it's not to be confused with what we talked about previously, which was the Fibonacci retracement, which only uses 2 points. So here we use namely the 61.8, 78.6, and 100% levels. And you want to make sure that you look out for this flash or lightning bolt shape that you see in the GIF here. Okay, let's look at a couple of examples of this. So here's a simple example. You can see clearly the starting, middle, and ending points follow the swing highs and lows of the price structure. So I don't know if you can see the lightning bolt shape, but following the arrows, the green arrows, and then you extend the tail out from the last point towards the ending. So basically where it ends, we're projecting a rebound off of that level. So over here, you can see the rebound occurs at the 100% Fibonacci projection level. Here's another example with a very obvious zigzag shape again. So yeah, we've drawn out what exactly you should look out for. So you want to take note of the Fibonacci trend line following the market structure closely again, and we're projecting the price to reach this 78.6% Fibonacci extension, so that we can see it rebound off of this level. Okay, so let's see how this plays out. And yeah, so you can see that price bounces off this level just as we expected. Okay, maybe I'll just pop the link for the Forex Army website in the chat first. Okay, and yeah. Okay, so here's another example. So we want to take note of this zigzag shape once again. This time we see it inverted. Okay, but it's still the same concept. So the starting point would be here, middle point, and ending point. And we're projecting where prices will bounce off of in the future. In this case, if you have the 78.6, 61.8 levels shown here, you can see that price has already broken out of these levels, and that's the reason why we're projecting it towards 100%. Okay, so let's see how this plays out again. Okay, so you can see price reversed off of the 100% level nicely. Okay. So you can also draw invalid Fibonacci levels. In this case, we're talking about invalid Fibonacci retracement levels, and because this tends to be more common than a Fibonacci projection level. But one of the most common scenarios of this is when price makes a lower low. Assuming you are drawing a Fibonacci retracement from the top to the bottom, then yeah, it will make sense for you to make for price to make a lower low. I'll show you an example in the next slide. But if there are bars on the right that break your ending point, it becomes invalid. There are Fibonacci retracements that are negative. Previously we talked about Fibonacci expansions that are -27 and -61.8. So even though those break below the 0% level, those are still considered valid. And I'll touch on those in a little bit. But this is the example of an invalid retracement. So price has already broken below the 0%, right? And that you see over here with the arrow. So price breaks our ending point on the right, and hence we cannot use this ending point as our retracement. So you want to always remember to pick the lowest point with nothing on the right of the ending point. Okay, now let's look at how we can combine all of the retracements and the projections that we've learned so far. Okay, I'll give you guys an example of um buying. So if it's the other way around, so if your starting point was here, ending point here, then it would be an invalid retracement if price breaks above that 0%. So basically, as long as it doesn't break below this 0%, then you're good to go. But we'll look more into this when we look at the charts. Okay, so let's talk a bit about Fibonacci confluence. So Fibonacci confluence is basically when you combine multiple Fibonacci retracement levels together so that you can increase the probability of your Fibonacci levels working versus a single Fibonacci level working. So it's basically combining all of your Fibonacci retracements, but also with your projection that we just learned. So in this example here, we have three different Fibonacci methods here. So firstly, we have the -27% Fibonacci expansion, which is indicated by the red arrow. That lines up with the 161.8 Fibonacci extension, indicated by the gray arrow. So for extensions, we look for a Nike tick. So this would be the shorter part of the tick, and the tail of the tick would be this black arrow here. And then we have a 78.6% Fibonacci projection. So you can see all of these levels line up closely, giving you a confluence area. So most of the time for confluence areas, we're looking for an area, like a small area, not so much a specific level. So it's okay if your levels deviate from each other by a little bit. Okay, so you can see price bounced off the Fibonacci confluence area over here. Okay, in this example, we have two Fibonacci methods. We have the Fibonacci extension, which is the Nike tick method. And this is the 127.2% Fibonacci extension level, and it's in line with the 61.8 Fibonacci projection level. Okay, take note of the flash shape again. And for the Nike tick, can see that it's an inverted V shape, but it's only valid once the tail exceeds past this 100% level here. Okay, and then we can see price bouncing off of this confluence area here. Similarly, here we have the same two Fibonacci methods, extension and projection. Here the 127.2% Fibonacci extension. So the Nike tick would be starting point here, ending point here, and then the tail is here. And that is in line with a 100% Fibonacci projection. So your starting point would be here, middle here, and ending point here. And you can kind of see the lightning bolt shape as well. Okay, so that all lines up in this area here to give you a reversal because of the strong resistance level. Okay, next, in this example, we use a 61.8% Fibonacci retracement that's in line with a 100% Fibonacci projection to give us a strong confluence area over here, where price has bounced off of. Okay, I think by now you kind of get the idea. It's basically just finding a bunch of levels that line up to form a stronger resistance or support level. So in this example, the minus 27.2% Fibonacci expansion, which is in blue, lines up with the 127.2% Fibonacci extension, which is in purple. This is also the inverted Nike tick. So the hit would be here, or rather the shorter part of the tick is here, and then the tail is here. That all lines up with a 100% Fibonacci projection to give a strong confluence area below here. Okay, so for Fibonacci expansions, if you were here for our previous webinars on expansions, you will know that for expansions, we're looking for a flash shape or zigzag or lightning bolt shape. So that's really similar to what we look for when we want to use a Fibonacci projection that we're talking about today. So typically, you would be able to use the Fibonacci expansion and the projection together. And how that would look like would be something like this, just without the purple arrow. So for an expansion, you would take the starting point and the ending point to be the first line of your lightning bolt shape. And then your projection would be the V shape that follows that same shape. Okay, I hope I'm making sense, but you can kind of just see it over here on the chart. Okay. Okay, so in this example, we have a swing low support over here and one long-term 100% Fibonacci projection that is in line with another short-term 61.8 Fibonacci projection. So that makes a strong confluence area over here where price bounced off at 81.084. Okay, so you can see price bounced off after this 61.8% Fibonacci projection line up with another Fibonacci projection. Okay, so following our Fibonacci techniques, trade management is also super important. So what we typically recommend is to place your stop loss beyond your key confluence area and your take profit before it. So for stop loss, the reason to place your stop loss beyond it is because more often than not, price is attracted to such strong areas of Fibonacci confluence. So if your stop loss is right before instead of beyond that confluence area, you'll most likely get stopped out before the market reverses. So that's also one of the reasons why people wonder why they got stopped out right when the market starts to reverse and then complain about stop hunting. So for take profit, we recommend to place your take profit before a key Fibonacci confluence area because there is a high chance that it won't be able to go beyond that level. So instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. And that's why people complain that the market is being manipulated, because they might miss their take profit by 1 or 2 pips. So you can see in the example I've included over here exactly how you should place it if you are going in for a buy entry. So the opposite, if you're going for a sell entry, it will just be the opposite. Okay, now let me pull up my charts and then we can take a look at some live analysis. Okay, feel free to let me know in the chat if you guys have any requests for any charts that you'd like me to go through. Okay, let's go ahead and maybe we'll start off by looking at gold first. Okay, so let's start off by looking at the higher time frames first so that we get an idea of what the general trend is. So on the weekly time frame, we can see price moving upwards. Okay, so we start off by looking for any trend lines or trend channels. I don't think we have a trend channel here. Okay, actually we do. So what makes a valid trend channel is if there are two touches, at least two touches at the top and at the bottom of the channel. Okay, so we have an upward trend here. If we look at our daily time frame now, okay, you can also see that um it's moving in an uptrend as well, also in an ascending trend channel. Okay, so let's add some support and resistance levels here. Okay, so here would be my first support and my first resistance here. So I typically will try and look to see if I can pull it back as far as possible so that we can see how significant that level is. Because the more times price has tested that level, the more likely it is to reverse off of it again. Okay, so this would be my second support. And then my second resistance would just be at this week high. Okay, let's look at our 4-hour time frame. So on our 4-hour time frame, we can see that price recently broke out of this ascending trend line, or descending trend line, sorry. Okay, so that gives us a bullish signal, especially because our daily and weekly time frames all gave us bullish signals as well. Okay, this was my first resistance, and then my second resistance is here. Um, I will place my first support here because we have two swing lows. You can see price testing it a lot, but it's cutting too many candlesticks here. So it's not a good support level to use. Okay, I'm gonna place a intermediate level here. And my first support would be here. Okay. So now we can go in with our Fibonacci levels. Starting off, I can see that we have a Nike tick shape here. Okay. So I'm gonna use Fibonacci retracement. So for retracements, we use the 100% levels. So 127.2, 161.8. And you can see that price is currently testing that 127.2 in line with the first resistance, and the 161.8 is also in line with our second resistance. Okay, and for our projection, you can see this lightning bolt shape. So I'm gonna use this trend-based fib extension. That's what they call it on TradingView, but I think if you're using MT4, they call it something else, but it's the same shape, the same symbol. Okay. And we use 61.8, 78.6, and 100%. Okay, so this 78.6 lines up nicely with my intermediate resistance, and 100% also lines up with my first resistance. So I'm just going to keep those two. Then earlier I mentioned that typically if you can find a lightning bolt shape for your projection, you can use it for expansion as well. So for your expansions, we're looking at the negative numbers. So you can see that they line up nicely as well. Okay. Okay, I'm gonna look for a retracement from here to here. For retracement, we look at the mid-range levels. Okay, so we can see the 61.8 lines up with, lines up with the intermediate level, and the 78.6 lines up with my first resistance. So I'm just gonna keep those two levels. Okay. So we can see we have three levels lining up over here. Actually, we have four levels lining up here. Okay, at our first resistance. So that area is likely to attract price. And it also goes back pretty far. So that's That's why when we're looking for levels, we want to push it back as far as we can without cutting too many candlesticks. Okay. Yeah, so we're seeing price testing our intermediate level now because it does have two levels lining up with it. So it is a confluence area, but it's not as strong as the first resistance. So we'll likely see it break above this level and head towards our first resistance. So now let's support this analysis by using some indicators. So I like to use Ichimoku and MACD because at one glance you can see exactly what the signals are. So price is moving above the Ichimoku cloud, so it's giving us a bullish signal. MACD is also giving us a bullish signal, so it also supports our analysis. And let's look at RSI and stochastic. Okay, RSI is also moving in an ascending trend line. Okay, but stochastic isn't telling us much. Now let's look at Bollinger Bands. Okay, you can see price pushing above the upper band. So it is also giving us a bullish signal here. Okay. I think there was a question about if it is an uptrend. If you'd like the recording, I think it will be better if you email IronFX, and they will probably send it over to you after this webinar. Because I don't have access to the recordings. Yep, so there was a question, if you're buying, will you trace from lowest price movement bottom to top? So if you're looking at a retracement, you would look like you would probably do something like that. And then retracement would be the mid-range. So we're looking at these levels. So yeah, bottom to top. So your 0% would still be at the top and 100% below. Okay. Do you guys have any requests for any charts you'd like me to go through? I think we have time for one more chart. Okay, let's go ahead and look at let's look at DXY. Actually, let's look at AUD. Okay, so on our weekly time frame again, you can see prices dropping. Okay, we see prices moving in this descending trend line. Okay, on a daily time frame, on the daily time frame, there isn't really any trend channels or trend lines, but it is, I wouldn't say it's a downtrend either. It's kind of ranging. Okay, so let's just go ahead and add some levels. So this is my first support. Then my first resistance will be here. And then I just place my second support somewhere here. And then of course at this swing high, that would be my second resistance. Okay, now let's look at our 4-hour time frame. Prices are also really kind of ranging as well. In fact, let's see if okay, no, there's no trend channel. Okay, so we have a support level here, and let's see if I can pull it further back. Okay, no. So this is my first support, and you can see that it's an overlap support, which basically means that there are swing highs and swing lows that line up with that level. Okay, and then my first resistance would be here. Okay, this would be my second resistance, and my second support would just be here. Okay, I think you can see price moving within this channel here. I think we would continue to see price kind of testing this area. But let's just do some analysis anyway. Okay, so starting off, I'm gonna look for a retracement. So I can see that price lines up, or rather this first resistance lines up with the 23.6. Yeah, I think the 38.2 as well. See. Okay, we don't have any projections. I think that's all the levels that we have. Oh, okay. So if we zoom out, we also have this retracement here. Okay, so my 61.8 lines up with my first support, 78.6 lines up with my second support, and yeah, so even though this 38.2 lines up with the second resistance, we can't use it because price has already broken out of that level. Same goes for this 50%. So we can only keep our 61 and 78. Okay. Okay, and my 61 also lines up with my second support. Okay, now let's look at our indicators. So price is moving below the Ichimoku cloud, so it's giving us a bearish signal. MACD is also giving us a bearish signal. Okay, so you might want to go for a sell from where price is at now to our first support. Since there is quite a bit of resistance at this level here. Okay, because we have two swing lows here. And can see price testing that same level with the 61.8 as well. Let's look at RSI. Okay, not much. Let's look at moving average as well. So moving average, what I like to look for when using that is looking for any of these crossovers. So crossover basically means that there is a change in trend. So over here, we could see price moving upwards. The minute we see price crossover, that's a signal that the trend is going to change, and then we saw price drop after that. So we could be seeing price continue to drop as well, or until it crosses over again. Okay. So yeah. Okay, let me know if you guys have any questions. If it's all good, I think someone requested for my LinkedIn, so I'll pop that into the chat now. And yeah, if there's no questions, that's all the time we have for today. I hope you guys found it helpful, and I will see you guys next week. Thanks, everyone. Bye.